Hey, everybody, and how are you all doing? Thank you so much for being here today. We are going to be talking all things insurance. So, if words like copay, deductible, out of pocket max, PPO, coverage allowances, uh, if that's kind of putting you to sleep right now, don't worry. It is not the most exciting topic traditionally, but we are thankfully joined today by Joe Saul-Sehy, who is going to be bringing the energy and demystifying insurance for us. Joe is the host of the Stacking Benjamin podcast, or at least a co-host of it, and part of a panel that speaks regularly on other financial podcasts. He is the co-author of a book called Stacked as well, which is a recent release, very easy reading, a great book to pick up if you are looking to kind of learn more about personal finance outside of your classroom. And I want to welcome Joe here. Joe, are you around? There you are.
I am. How are you?
I'm doing awesome. How about yourself?
Well, I'm better now that I'm here with you because I have to tell everyone that I made a bunch of mistakes, man, with insurance. I made so many mistakes when I was younger. And because I finally figured it out, I thought this would be a great. I was so happy when you asked me about this topic, because if we can just teach everybody about some of the stuff that I've learned so that they avoid some of the mistakes I made with insurance, I think we'll have a great session.
Yeah, insurance is not the most exciting of topics to talk about. It's also one that most Americans feel very unsure about. A poll by Bend Financial found that 56% of US adults feel completely lost. That's the response they gave when asked about their health insurance coverage. 65% don't know the difference between an FSA or a HSA account, or even what they are probably. And most Americans are receiving a D grade when it comes to their knowledge about insurance. So this is not an uncommon thing. And for our audience who are teenagers in high school, I'm sure you haven't come across much need to know about insurance up until now. And it's not something that doesn't really impact you as much until you get into your 20s, 30s, and then you really start using it a lot and you realize how little you know.
But that's why I find it so exciting, is because of the fact that it's a little bit like riding a bike. Like when we get done with this, I think everybody that's with us is going to have this framework that I feel like is so easy, Rob. It is such an easy framework that your insurance decision making will become instantly better. And when you get to be 55 like me, you would have made a bunch of better decisions and had a lot more money in your pocket than that I maybe could have had I made better decisions.
Yeah, and I think that is our goal by the end of today, is that we have given you a basic overview of what insurance is, why it's important, how you can use it, what types of insurance you need, how much coverage you need. We can't break down all of it. There is so much to insurance, but we will give you that bird's eye view that will give you the tools to go find out more when you need to. And you will feel at least confident moving forwards that you understand what insurance is all about. Before we start, though, you should have a student reflection document if you're watching live, or if you're watching the replay. That is just questions to help guide you through our conversation today and make sure you're kind of getting out of it what we want you to. You can find that attached to the email that was sent out to you teachers, or you can find it in the description of the YouTube video if you're watching the replay. The first part of it was, what do you know about insurance already? What questions do you have? So just do a quick check-in on what you know already and what questions you still have. If you have questions that pop up during our conversation, please put them in the chat feature and we'll try our best to answer them for you. If you're watching the replay, drop your questions in the comment section and we will get to them when we can. All right, Joe. First question, why do we need insurance? What's the whole point of this thing?
Well, the cool thing is, and this is the neatest thing of all, Rob, is that we might not need insurance. And this is where I just want to completely change the game from the beginning. The insurance industry wants you to ask the very question, Rob, that you just asked. Why do we need it? What do we need it for? And so you watch it in a commercial. It's always about the car accident that you had, or the disability that you saw, the Aflac duck, right? With the disability coverage, or whatever the topic might be. They want you asking that question. There's actually a bigger question that you should be asking, that the insurance industry, I think, is okay with us asking, but it's going to be better for you and you're going to make much better insurance decisions, which is this: what are my biggest risks in my life? And how am I going to cover those when something bad happens? So what are the biggest risks and and if you ask that question, then you open this up, Rob, where it's not just about insurance anymore, Now it's about empowerment, right? How do I make a decision about these things? And I'll give you an example. A lot of people, when they go into the workplace, they buy a type of coverage called accidental death and dismemberment insurance. Well, accidental death and dismemberment insurance people buy because it's cheap. It's a benefit that you get. Let me tell everybody what this type of insurance does. Everybody checks yes to. If you lose a finger, if you lose an eyeball, if you lose maybe a limb, it will pay you 1 times, 2 times, maybe even 3 times or 5 times, whatever your salary is. It might help pay for the surgery, whatever that is, to give you coverage for that incident. Well, back when I was a financial planner, Rob, I would meet all these people that had desk jobs working on a keyboard who bought accidental death and dismemberment insurance. Because what if I lose an eye? Well, the probability if you're sitting at your desk of, maybe the person at the cube next to you throwing their pen and it lodges in your eye, or, with your finger, you're typing away on your keyboard and all of a sudden you slice off your index finger between the J and K key. It ain't going to happen. And so what's cool is we get rid of that discussion about insurance and instead go, what's the risk? Well, there's very little risk of me losing an eye or losing a finger if I work at a keyboard all day. So matching probabilities to problems is really where we want to start with insurance. And then we need insurance. So to directly answer your question, then we need insurance when we figure out that the hole's going to be so big. This hole is going to be so massive that we can't easily clean it up. And this is actually where the insurance industry actually sprang from. Like, I don't have an actual historical quote, but I made one up for my book. And in my book, Emily and I, my co-author, we said, there's this little village in some little town near where you live. And a long time ago, somebody's house burnt down and they didn't have enough money to replace it. Well, the village is made up of all these nice people. And they said, well, what if that happened to one of us? Like, how do we make sure that if this happens again, that we can cover it? Because that is a big enough problem that if we can't rebuild the house, what are we going to do? So instead, what they all decided to do is put a barrel in the middle of the village, and they all threw money into the barrel. And then when somebody had something bad happen, well, then they took the money out of the barrel. Well, that barrel is insurance now, right? That's what we do. We're putting a little bit of money in every month so that if we have this big catastrophic thing where we can't afford to make the payment ourselves somehow, we can grab a bunch of money from the barrel and it's covered.
Okay, so we're reducing the risk of our finances getting blown up and going up in flames because some catastrophic event happened. But doesn't it just feel like a waste of money that, like, I'm basically paying for someone else to screw up and lose their stuff, break their stuff, and then my insurance money that I've been paying in is going to pay for their stuff now? Like, why am I doing that?
It brings up a great question, which is fascinating about insurance, because the answer to that is, of course it is. And frankly, we hope we lose money, right? I'm like, I don't hope my house is going to burn down. I hope I don't get disabled. Hope I don't get in a car accident. Like, I don't want any of those things to happen, which is why we go back to my initial thing, which is, what's the probability that it'll happen to me, right? If I start off with the things that are the biggest risks that I have, and then I ask the question, what would I do if these happen? And I can't figure it out with my own money. That's when I plug in insurance. Because what insurance does is, let's say that, to build a new house, it's going to cost me $150,000, let's say. If it's going to cost me that much money, Rob, what's the chance I can come up with that money today? Well, I can't. So wouldn't I rather do $1,000 a year, $2,000 a year, $3,000 a year, whatever the premium is, $3,000, hope it doesn't happen. But if it happens and I've only accumulated, say 5 years later, if it's $3,000 a year, I've accumulated $15,000 toward it. I've accumulated $15,000 that pays me $150,000. That's a pretty good deal. So it's a way to play the probability game. Like, people think of probabilities. If anybody's ever watched poker on TV, these professional poker players, they're so good at knowing the risk. When they look at a hand of cards, they know, okay, if I bet on this, this is the bet. And that always kind of eludes me. But it's the same exact thing with insurances. If I'm playing the probabilities, I start off with that question, what's going to really sink me, and work backwards. And you know what? Then I'm happy to pay for somebody else, because of the fact that if it does happen to me, then I'm covered.
Yeah, insurance is one of those things that we pay for in some cases through our entire lives. And we hope that we never actually get our money back, because that means some bad event has actually happened. And more than likely, you wish the event hadn't happened and you didn't have the money instead. So when you buy insurance, you are essentially buying peace of mind.
Yes.
That is the product you're buying. You're transferring your risk from yourself to somebody else, and you are paying for them to take that from you. And
Can I bring up,
go on.
yeah, can I bring up something kind of fascinating? I think that will make this, because like you said, a lot of people think this is really boring. Let me turn this Rob into something I think that makes it fascinating. We talk about risk management. We also have to look at, when you said, well, somebody else getting that money, right? We also, with insurance, we look at who else is likely to buy that insurance. We, on our podcast, had a woman who was a professor at MIT on our podcast recently talking about this. And she talked about, I'm sure a lot of people there might remember Movie Pass. You know, this thing where you could go see an unlimited number of movies. It was out just a few years ago. You could see an unlimited number of movies, and Movie Pass, you just paid them a subscription. Well, I'm a guy that every Tuesday, my wife gets every Tuesday afternoon off work. So guess what? Tuesday's discount day anyway, Rob. So Cheryl and I would go see a movie almost every Tuesday. I saw 42 movies last year, to give you an idea. So when Movie Pass came out, well, that was going to save me a ton of money, right? I'd already done the math. And so I buy Movie Pass. A ton of people do Movie Pass. And then if your Movie Pass, I don't remember what the subscription was, but let's say it was $25 a month. It's $25 a month. What is everybody that buys Movie Pass going to do? They're going to make sure they go to the movie theater enough times where they get their $25 worth. So there also, when it comes to insurance, there's this concept of the pool of people that are also throwing money into that barrel along with you. And with Movie Pass failed. If people don't remember a Movie Pass, guess why it failed? Because the pool of people that were throwing their money like me into the bucket were people that were going to make sure they got every dollar of value out of that. And it sunk the insurance, which was the Movie Pass company. I've heard this, by the way. I didn't make this up. The MIT professor talked about this. If you're going to buy pet insurance is a fantastic product. Of course, if your pet gets into trouble, plenty of people with stories where pet insurance helped them afford some of these surgeries. Pet insurance is very, very expensive, but it's expensive, Rob, because it turns out that the people that buy pet insurance are all very much pet lovers who don't care what they pay. So the insurance companies have jacked up the rate on pet insurance because pet owners are likely to take their pet to the vet a ton. And so it costs a bunch of money to buy it. So to your point of somebody else, I also have to look at who else is going to be buying this besides me, which I find pretty fascinating.
Yeah, because we think about something like a gym membership, same idea. Like we're going to charge an amount based on what we think the facility can hold and people will use, and repairing all the stuff and then making a profit. And we know that 60% of people who buy a gym membership will not come back at some point, and they will be covering the cost of everyone else. Right. Some insurances like health insurance are legally mandated that you have to have it. Auto insurance, you have to have it if you want to drive, but pet insurance is optional. So like you said, not everybody's going to take us up on this. So the pool of people who are going to put money into this insurance pot is smaller, which can impact how much we charge each person. So it can become cheaper or more expensive. In my classroom, we do a cell phone insurance policy where we think about everyone's cell phone in the room. How we ask, show of hands, how many of you have broken a cell phone in the past year? And we'll usually get one or two. They've either lost it, it's been stolen, they've left it out in the rain, they've dropped it in the toilet, whatever you want to do. And we're like, okay, so in a pool of 25 of you, 2 cell phones every year on average are going to break. What's the cost of replacing it? And then we figure, okay, let's all chip in enough that we could replace those 2 cell phones every year, and everyone pays that in. And the students get a very quick idea of, oh, okay, this is how insurance would work. And then the first question they have was, well, I'm much more responsible than that other kid is. Like, why do I have to pay the same amount? Does insurance work the same way? Like, is it based on how responsible you are, how healthy you are, how good a driver you are, things like that?
The insurance industry kind of does. When they do, insurance sends you through something called underwriting, where they decide what type of risk you are. As an example, if you know somebody in your family who's had an auto accident, and if the person paying for that policy, maybe it's you, maybe it's another family member who's paying for that policy, gets all frustrated after the accident, that's because you just got in a dirtier pool of people the insurance company put you in with the pool of people who have had accidents. And if you have one, you're more likely to have a second one than somebody who's never had any. They have pools like I know Liberty Mutual, I believe, has and I think other companies do too. I think Allstate has this as well, and maybe a few others, where if you get good grades in school, if you're a new driver, 16, 17 years old, and you have good grades, the statistics show you are less likely to have an accident. So they will discount the cost of your policy because of that. So if somebody's safer with their cell phone, Rob, and you have actuaries at the company, these people that do the scientific research to determine what type of risk you are, they may give you a discount because of the fact that you've historically never had a claim on your cell phone before. So this is where the discounts become important, and to ask your agents for discounts. I never really knew to ask for discounts. Now, the bad thing is a lot of these insurance people are paid a commission based on the amount of that you pay the insurance company. So for some agents should give this to you, but you should ask whenever you get insurance, say, what discounts am I eligible for? And sometimes it even makes sense if you just get this weird feeling about your agent. Well, number one, I'd switch agents. But number two is if for some reason you don't switch agents, just call the 1-800 number at the company and say, hey, what discounts what might I be eligible for? Can you give me a full list of all the discounts that are on this policy if I'm really good? So some people will get a preferred risk if they're safer with their cell phone, to use your analogy, than people that constantly are losing it.
Okay. So, and this depends on the type of insurance. For example, auto insurance, most of us, we go get our own policy. So you start driving as teenagers, you're probably on a parent's policy, not on your own one, but eventually you will get your own policy. So you are insuring just yourself or maybe a spouse or a sibling on your car insurance as well. For something like health insurance, you might get it through your company. This is what we call a group policy. And that's where the company is saying, look, we've got 1,000 people. We're going to get an insurance policy that covers that 1,000. And it's less about you as the individual, which is great in some cases. So for example, if you're sitting here watching and you have a health condition, so something that is with you your entire life, or you have a history in your family of certain health conditions, on your own, an insurance company might look at you like, oh, you're a higher risk of needing to use your insurance. We're going to charge you more. If you go in on a group policy, so with your company, they don't really get to look at the individuals like that. Instead, they just kind of assume everyone's sort of the same, and they give one rate that the employer typically helps you pay for as well. Yeah. Am I missing anything on group insurance?
I'm sorry?
Am I missing anything about group insurance that you would add in here?
No, I just say from my personal experience back when I was a financial planner, Rob, there were instances where going with group insurance then would work in my client's interest, and we would buy the group policy. However, we were always worried, what if you lose that? What if you leave that company? People are leaving companies more often than before. When people watching start off their career, they may be with the first company they're with out of high school, out of college for just a year or two, maybe 3-4 years before they switch to another company. So if somebody is healthy, it might actually make more sense if you know you're going to get those discounts, you know that you're a preferred risk. It might make sense in some cases to go look on your own. Now, with health insurance, that's not going to happen. Health insurance is usually almost always better through your company. But when we look at things like your life insurance, your disability coverage, these things that you know you might need for a longer period of time, those types of insurance, it might make sense if you think you're a preferred risk to go get your own and take it from place to place and not have to worry about what's going on with this group of people, because those prices are going to change all the time.
Yeah, and we've thrown out a lot of different types of insurance so far, and I do want to do a recap on what are some of the most common types of insurance we see, because there's literally insurance for everything. Like you hear of celebrities insuring body parts and things like that. This dismemberment insurance that you talked about earlier. The most common ones, what would you say the average U.S. adult needs to concern themselves with? What are the types of insurance that should be on our radar?
Yeah, again, Rob, I'm just going to go back to what are the biggest risks that you have. So these are a little bit old statistics, but with a car, you have about a 1 in 350 chance of something happening to you every year. So 1 in 350 chance there. With a home, if you end up owning a home, about a 1 in 1,200 chance of something happening to you. When it comes to a disability, depending on whose statistic you believe, this is where it gets ugly. It's between 1 in 3 to 1 in 6 people will have some type of a disability during their career. And of course, the chance of us dying, like I've heard people say, well, if I die, no, the answer is when you die. Right. So if you think that there's a chance you may die and the people you love, the organizations you love don't have enough money to carry on, well, then life insurance is a 1-on-1, but it truly is about, do I have enough assets at that point? Have I built up enough money? Have I stacked enough Benjamins to be able to get what I want to get? So I would say in order of importance, understanding what your options are for disability insurance is number one. That is the goose that lays the golden egg, right? You want to insure that goose and make sure that you always have a paycheck. This was the one when I was a financial planner, by the way, people never wanted to talk about because I'm a really safe skier. I'm really good on those skis, so nothing's going to happen to me. It's not about you. It's about all the people around you, and bad things happen when you don't expect it. But then second, of course, is car insurance. As you mentioned, Rob, you have to have car insurance. And of course, if you have a mortgage on a house, you're going to have homeowners. Another offshoot of homeowners insurance is renter's insurance. And renter's insurance is super important when people if they go off to school, they get their first apartment. If the apartment, I can't tell you the number of times where, somebody's neighbor in an apartment building has a kitchen fire, and you're in the apartment next door, and now there's this smoke damage in your apartment. The company that owns the apartment building is not responsible for your clothing being laundered and getting that smell out. That's all covered through rental insurance. And the apartment complex will say, we'll make sure that your place is safe and that the place doesn't smell anymore, but any of your contents are not covered. Or the number of times like a pipe broke. I've heard that story over and over, and now there's, a flood and you lose some stuff in that.
And a lot of these will be required. So if you go rent from a private landlord, a lot of times what you will find out is that they will say, we require you to have renter's insurance to be able to live in this home. It won't be every single one. It's not a law, but it's something that most responsible landlords will do. So don't be surprised if you see that in the coming years when you try and rent your first property, that they're like, yeah, you have to have renter's insurance.
Well, can I also say something there? Because I've also seen, so I had these neighbors that lived across the road from me whose house burned down. And while the fire trucks are out in front of their house, and by the way, I was friends with the assistant fire chief. This fire was so big, Rob, they had a picture of it in his office later. Like, this is how big. They're on the roof and they're poking holes in the roof so the flames can come out the top. It was sad. Well, it turns out that these people were living very close to money was very tight for them. And so they let their homeowners lapse and they didn't get new homeowners. And this is a mistake people make when money gets tight. And money for most of us at some point will get really tight. I go over in my book, I've talked about it in my podcast. I had a time when I was horrible with money and I didn't know where my next meal was going to come from for a while. When money gets tight, the first thing we do is we get rid of some of these insurances. That always seems to be, Rob, when the worst stuff happens. Like, the bad stuff always happens. So I would caution people, don't get renter's insurance just to show your landlord and then cancel it the next month, because I hear a lot of people do that. I would keep it.
Yep. And same thing with your homeowner's insurance. Most mortgage lenders will require you to have it. And in fact, they'll pay it on your behalf to make sure that you have it, and they'll collect as part of your mortgage. So yeah, these are things that are important to us. They protect us from that risk of financial ruin. And it is just the law of the universe that the moment you don't have the emergency fund, the coverage for this, that's when stuff happens. And usually more than one thing happens at once. They always seem to pile up at the same time. But speaking of emergency funds, like, if I beef my emergency fund up enough, couldn't I just potentially say, like, you know what, I don't need insurance. I've got 10 grand sitting in a savings account. Like, I can cover most things.
I love that you said that, because you know what? As you said, what are the insurances we should cover? Emergency fund is number one. It's your number one insurance policy of all. And this is why, and I get these Uber nerds sometimes online that fight me on emergency fund. Well, why don't I just use my credit card to get out of an emergency? What if you lose your job right before the emergency happens and then your credit goes bye-bye on top of that? What if we have a credit crisis like we had back in 2007, 2008? What if that happens and the company, no fault of your own, all of a sudden companies were closing up credit? Like, why can't I bet my next paycheck on that? Like, there's so many ifs. An emergency fund takes care of all those things. And people will tell me, they'll say, well, an emergency fund doesn't pay much because you want to leave that in cash. The interest rate you get on that money is horrible, but that's not the return on investment. Let me tell you what an emergency fund truly does. That's why my beginning answer to your first question about what insurances should we think about was, we should have first think about risk management. What are my risks and how do I protect against them? So if something happens to my car, I have to have car insurance. But Rob, if I have an emergency fund that's 6 months worth of money in the bank, or even just a few $1,000s in the bank, I can maybe raise my deductible on my car insurance. Now, the deductible, what a deductible is, that's the amount I have to pay before the insurance kicks in. But if I have the money sitting in a bank account, I don't have to pay an insurance company for this anymore, which is a powerful, nice place to be. So now I could have, let's say, $1,000 deductible on my car insurance. I could have a 1% deductible, maybe on my homeowner's insurance, or a $500 deductible on my renter's insurance. I can raise those. And guess what happens when I raise the deductible, which is the amount I'm going to pay? The insurance company goes, oh, we're going to charge you less because we're covering less. And now if it's 1 in 350, I said, is the chance of you being in a car accident, a lot of those car accidents are less than $1,000. So I'm less likely to file a claim. So the insurance company may even put me in a different pool of people where they take less risk because of the fact that they know I'm less likely to file a claim. So now I'm paying a bunch less money for insurance. And if something happens, which is only a 1 in 350 chance, I've got the money sitting there to handle it. If I get disabled and I can't work and I've got 6 months worth of money, I don't have to have that Aflac Duck insurance, right? Which is short-term disability insurance. I can just say bye-bye to that. Don't have to have it at all. So some of these insurance policies, pet insurance we talked about earlier, if I've got enough money to cover that pet surgery, I can even forget about the high cost pet insurance out there that a lot of pet lovers go, well, it saved me. Well, now you don't have to worry about an insurance company saving you. Now your own emergency fund can save you, which is a great place to be.
And this kind of feeds into a question that came from one of my students. Aaron asked, should I start with the cheapest amount of insurance coverage and then increase it as my wealth grows? Because surely I have more to protect as my wealth grows. And I want to throw that at you. What do you say to that?
I say to Aaron, and unfortunately, I would go the exact opposite way. When you don't have much, and that goes to income and assets, you might not have a lot to protect right now. However, you also don't have resources to cover those big risks. So I would start off with more insurance, which is not what you want to hear. But as you build that emergency fund and you build those assets so that you have things to draw on and you don't need the insurance company anymore, then go to cheaper insurances. I always get discouraged when I see somebody who's just starting out with razor thin margins on their difference between what they earn and what they spend is right here. It's very, very close. And they have very little insurance. I know one bad thing happens to this person, Rob, they're in huge trouble. So I like seeing that they're protected. And if something bad happens, which it will, it's funny. I say, if something bad happens, in the last month at my house, I've had a tree in my yard that looked like it was stable go down, and I had my dishwasher break. Like, those have happened in the last 3 months. I always like saying, if something happened. And by the way, the check my tire pressure light was on in my right front tire just two days ago, and I'm still not sure what's going on there. I took it to Discount Tire to have it checked out, but who knows? So I always say, if something comes up, but stuff always comes up. There's always things derailing your plan. And if you start off with a good amount of insurance and then build that emergency fund and then lessen it, I think you're more likely to keep that ball rolling and you can focus on the big picture stuff. Because this discussion we're having today is not where the money's made. This is truly not how you get to high net worth status. High net worth status is using that brain of yours to not focus on all these little things, my tire pressure, my tree in my yard, my dishwasher breaking down. It's on, how do I do the thing that's my unique talent? That's where I'm going to make lots and lots and lots of money. So the more you can automate the little things through either insurance or emergency funds, so you can focus on the big stuff, the better off you're going to be.
So moral of the story, insurance is not something you skimp on, particularly in the beginning of your financial future, because you can find a big disaster could put you into a ton of debt at a very early stage, and that can stay with you for a long time. Couple of words that we're throwing out here. Joe did a great job talking about deductible. This is the amount of money you pay before insurance helps you out. Your premium is how much your insurance is costing you each month or every 6 months or every year. So that's the amount you pay for this coverage. Your coverage limits are the amount that your insurance policy will pay out. And one area as well that we can skimp on is our coverage limits, particularly when it comes to auto insurance. So with auto insurance, there is a minimum required by your state that you have to have. It includes bodily insurance or bodily injury coverage, the total cost of medical cost for a car accident, and then property damage. And the minimums are not that high. It's like 15,000, 60,000, 15,000, like total damage in Maryland. And it's like, if you have the bare minimum, like you better hope that you crash into like a 10-year-old Honda Civic and not a brand new Mercedes, because you're going to go over your coverage limits very quickly if you opt for the cheapest stuff out there. So remember that in the beginning, you are at a higher risk of financial ruin. As you gain wealth, you hopefully get older and you start building this wealth up, you should be able to provide a lot more of your own insurance through your emergency fund, and you can maybe reduce the amount you're paying in premiums. But in the beginning, it's going to be a little bit expensive, but it is money well spent, I feel like, even though we cross our fingers and hope that we will never use it. All right. So, Joe, as we get older, does life insurance become something that we do need to think about? Because that was one of the ones you didn't list on your, like, everyone should have this list. You had disability, auto, health, homeowners, renters, talked about the emergency fund, but life insurance didn't make your list.
Think about life insurance and the risk. This is a horrible thing. If you are in school right now and you're not earning much money and you have somebody else paying for a roof over your head, insurance need is based on what people are going to need when you pass away. And just ask yourself, what does somebody need from you and from your money if you died? Now, if you're watching this and you have a child, you know exactly what I'm talking about. You've got a little mouth to feed that is going to need that income that you bring in if you pass away. So you have to look at what the insurance industry calls insurable interest, which is who out there is going to need money to cover things that you were covering with your paycheck. This is an important one, Rob. You and I know this because when you get out of school, what's going to happen is you're going to have friends that get out of school and they go work for an insurance company. And the insurance company is going to tell them to call all their friends, and it's going to tell them how much they should buy insurance and why they should buy insurance when they're young. They're not wrong. Insurance is cheaper when you're young, but there's absolutely nobody relying on you for income. And so you have to ask yourself, how long am I going to waste money on buying an insurance type that I don't need to possibly save money over the long term? I would disregard life insurance personally until you have people that are relying on you for that income stream that you can't provide. So build an income stream first, build a group of people that rely on that income stream outside of you, and then begin thinking about insurance. Now, there is a risk there, and I should mention the risk. If you have develop some health issues later on, and you take my advice, and those health issues develop before you go out and look for life insurance, you may not be able to get it later. So every decision you make has risk, whether you buy it early or don't buy it early. I frankly would take that risk. The chance of that happening, again, we're just playing probabilities here. The chance of that happening is not high, but I think you also have to look at your family history and do some serious thinking there about what your expectation might be that could happen. But generally, I'd say to a large audience, Rob, like yours, I'd say let's wait on the life insurance.
Yeah, life insurance is going to pick up the pieces when you're no longer there. So my wife and I, for example, we got life insurance when we were considering getting married. So right as we were engaged, we were like, marriage is on the horizon. If one of us passes away, we've gotten very used to having two incomes to support the things that we're doing. It would allow the other person to grieve and maybe not work for a while. Like that was one of the reasons. And then we also bought a house. And now that we have a mortgage, which has a very large debt attached to it, we wouldn't want the other person to be stuck with that giant debt on their own. So for us, the policy was there to, again, pick up the pieces when one of us passed away so the other wasn't left in a financial ruin as a result of it. Funeral costs are actually kind of expensive too. So if your emergency fund is not there, it can cover that. But that's something that you should talk about with your close family members as well. Go on ahead. You want to add something?
Can I say, and I'll say one more thing about life insurance. If anybody watching this, hanging out with us today has TikTok, you've seen some of these videos on TikTok probably that I see all the time. They might just serve them to me because they know what I do and they think I'm interested in financial stuff. But it's this garbage about using, and I say the word garbage deliberately because I think it is garbage, using life insurance for all these other things besides life insurance. If you can't fit your insurance strategy on a napkin, you are using it, I believe, the wrong way. There are cleaner ways to use insurance than the ways that people talk about on TikTok. I saw a video yesterday where one guy is going through buying a car and using life insurance to help you buy a car. And by the way, he's using a bunch of half-truths that somebody like me who's been doing this for 30 years knows they're half-truths. He's not saying anything wrong, but what he's doing is hiding a lot of stuff that he's not telling you that's going to really hurt. And it stunk, but it was one of those side-by-side videos where there's a guy in a hat going like this. Yeah, this is smart. This is great stuff. And it made me even think, a guy that's done this forever, go, oh, yeah, look at, wait, maybe I need to listen to this. And then the more I listened, the more I went, this is just garbage. But people with us today don't know that that's garbage. So people are telling you to use life insurance for anything other than life insurance. I would run the other way than insuring somebody else. That advice right there changes immensely if you're somebody that accumulates 5, 10, $15 million. Like when you get to 5, 10, $15 million, then we'll start talking about complex life insurance strategies where things get really wild and cool. And this becomes a totally different conversation. But until that point, please do not try to use a life insurance policy to buy a new car. Like, don't.
Can't even fathom how that works. But yes, that's a great reminder that social media, remember, is an unregulated space where anybody can throw out any information they want. And just because it's gaining popularity does not mean that it's great information. And you always have to be very mindful of how you evaluate new information like that. With life insurance, there are two main camps you can fall into. There is a term life insurance policy and a whole life insurance policy. As Joe said, typically the rule of thumb, I would say, within the financial world is that if you are a high net worth person, so $5-10 million, like maybe whole life insurance might make sense for you then. But would you agree that for most young people who are just the average Joes, Janes, whoever is out there, like term life insurance is probably going to be the better option for you?
Yes. And let me explain why, so we don't just use shorthand.
Yeah. And what each one is in like in a short nutshell, if you can.
Absolutely. So term life insurance means it's going to cover you for a term of time. And that term might be 10 years, might be 20 years, might be 30 years. Just ask what the term is. What you do is you're thinking about how long is it going to take me to build a big nest egg. You know how earlier we talked about when you build up an emergency fund, we can start buying less insurance. Well, once we build up a net worth, that the people that are relying on me for money no longer have to worry about how much insurance I have. They pretty much can live off of my big pile of assets that I got in my basement. No, don't keep it in your basement, but you know what I mean? I got so much money that they can just live off that. Then I don't need insurance anymore. So at that point, you can then get rid of your insurance. So for a lot of people, traditionally the age people want to retire is 60, 65 years old. You and I know a bunch of people that to pull this off at 35, 40, 45 years old. They do some cool stuff. But if you've accumulated enough money that you don't have to worry about it, well, then you can get rid of your life insurance. So for most people, a good fallback number is make sure it lasts to 60 to 65. Get a term that lasts you until that point. At that point, if you've got enough money to retire, then you have enough money for you to live on. Somebody else could also live on that money if you pass away. Or also at that time, your kids may be old enough, or the people that rely on you may be old enough that they don't need your money anymore. So both of those things may happen, and then you can get rid of it. What's cool about term life insurance, remember how I talked, Rob, about probability? Probability is really important with all the other types of insurance. With term life insurance, it's weird because this is the one insurance that actually works the opposite way. Depending on the study that you see, an older number that I have shows that somewhere between 2 and 3% of people that have term life insurance policies actually ever end up using them. 97 to 98% of the time, it was a waste of money because, yeah, you died, but you died after that date when the policy expired. Well, if we think about it from just a cost in versus the amount out, we know we're probably going to need life insurance at some point. And when that occurs that we need it, knowing that the probability is I probably won't die young and I will be able to build assets, I just want to be able to duct tape. So my goal is to make sure that if that catastrophic thing happens, my heirs aren't left to worry, and I can pay the least amount possible to make sure that they don't worry. So with life insurance, the reason we recommend term insurance is because of the fact that the probability of it happening before you build an asset empire is so small that you just want to cover that catastrophic thing, and that's it.
And then whole life insurance is just kind of exactly what it says, isn't it? That you're just paying for this your entire life. And upon your death, there is a beneficiary who'd receive a payout of money. But there's also that other side of it that kind of gets the bad rep. What is that?
Well, here's the deal with whole life insurance. If we just think about life insurance in general, insurance gets sold. Imagine it gets sold at a store. And Rob, you walk into the store and you say, yes, I'd like to buy $100,000 of insurance. And they tell you that the insurance is sitting over there in $1,000 blocks, right? So you go pick out 100 of them, you put them in a bunch of shopping carts. When you get to the cash register, they ask you, how old are you? And the reason is every time you have a birthday, the chance of you dying gets a little bit more. So what happens is that insurance by thousand actually gets a little bit more expensive every year. Now, there's a reason I'm bringing this up when we talk about whole life insurance, because people online will tell you whole life insurance is garbage because it's way more expensive. It's way more expensive, not because it's garbage, but because of the function of what I'm explaining right now. Because if your term only lasts till you're age 65, between now and age 65, what the company will do is they'll take kind of the average of that price increase every year when you have a birthday, and they'll give you the average of that. And so you'll pay a little bit more when you're in your 20s. You'll pay a little less when you're in your 50s, but overall it'll even out to be commiserate with the average of what it would cost per thousand for that time. Well, imagine that extends past 65. Imagine you're 85 years old and you still have to buy that $1,000, and they ask you what your birthday is or how old you are. They're like, oh, heck, you're 85 years old. The chance of you dying, sad to say, pretty darn high. So if it's high, they jack up the rate. The reason whole life insurance is super expensive is because when you're in your 20s, you're trying to prepay a lot of that 85-year-old super expensive insurance when you're in your 20s. So when somebody tells me, they go, hey, I pay $150 a month for my life insurance, and another person tells me they pay $12 a month. There's a couple things going on there, but one of the things, Rob, that's going on is you're subsidizing those older years, because the chance a whole life policy is going to pay out is 1-to-1. Like if you die and you own it, it's guaranteed to last your whole life. They're not very creative at coming up with these names. It's called whole life because it's guaranteed to be there your whole life, which is why it costs so much. So what happened, and this is the groaner, the reason somebody might pay $150 for this whole life insurance, the subsidization of those older years, that goes into something called the cash value. The reason life insurance companies came up with cash value, again, is when internally the cost gets more and more expensive, they can go grab that money and pay for it so you don't have to have it come out of your pocket anymore. I mean, think about it. If you have a car that the payment should go 10 years, but you only want to pay it for 5, you're going to pay a higher payment per month. And then you drive it for another 5 years, but you're no longer making payments. Same thing here. You want to stop paying at a certain age. Let's say it's 60 years old, but you want to keep having coverage in your 70s and 80s. Well, you're still paying, but it's coming from all that prepayment. Well, insurance agents realized back in the 80s and 90s that these insurance products, we could call them savings accounts. And the interest rate they were paying to try to keep up was pretty commiserate, looked really good when compared to a savings account. So insurance agents began selling them for the wrong reason. Hey, use this as a college fund. Use this as a separate emergency fund. Do something that they talk about infinite banking. Use it infinite banking. The sad thing about infinite banking, which is what I was mentioning earlier, this garbage thing where you're buying a car, taking out these loans from these policies and paying yourself, they actually work, Rob. The problem is they work until they don't work. And when they don't work, they unravel very quickly. And when they unravel, you end up having a lot of money that you spent that you didn't have to spend if you just did it the straightforward way.
Kind of sounds like a Ponzi scheme where you are the only participant in it, but
it totally does to me too. And I know if they were here with us, they would go, no, it works. And it does. And you know what? They're not wrong. It can work if everything goes perfect. When I was a financial planner, my goal was hope for the best and plan for the worst. And I think that's always great advice, right? If we plan for the worst, we're going to make the right insurance moves. We're going to do things in the way that if it's worse, and if I'm betting on the worst, I'm not using my insurance policy for anything other than insurance.
Okay, so you guys have it there. Stick with that term life insurance. Let's get away from life insurance for a moment and just talk about just general insurance. And Joe, how do we shop around for this stuff? Like, I know if we have a job and your health insurance is provided through your job, it's like, okay, cool, check, I will take that. That's a very simple decision to make. But when it comes to things like auto insurance, which might be very top of mind for a lot of our viewers, how do we shop around for this? How do we make sure we're getting a good deal? Because we don't want to be sold something we don't need. We know that the industry can have people overselling things and getting you signed up for stuff that you don't need because it is such a cloudy, murky environment that most people don't know a lot about and aren't very willing to admit that they don't know a lot about it. So we can kind of end up just being like, oh, yeah, that sounds good. And signing up for whatever they tell us. So how do we do this? How do we navigate this insurance world and get the best deal for us?
First thing is, number one, go online and get the basic terms, because I've, gone to lunch with insurance agents before, and insurance agents will tell you the way they beat the competitor's rate is the competitor has an apple, they show you an orange, which is a different policy that has some of those things different. So you have to be able to read what's called the deck sheet of the declaration of coverage, which is a line by line of this is exactly what I'm getting. And you know what? That seems very difficult to figure out, probably outside of the scope of our discussion today, Rob, but there's tons of Google searches you can do, which will take those line by line. And I'll tell you this, it's really cool. It's not hard. They're not difficult. Might sound difficult. Within 15 minutes, you can get conversant on all these terms and whether you need it or not. And then when you're actually then going, so know the terms first before you shop. And I think that's important because you don't want somebody giving you smoke and mirrors treatment. You also get a lot of insurance people that just speak shorthand because they do it every day. Like you corrected me when I said the word premium, and I didn't realize, I didn't think about the fact people don't know the word premium because we don't use that in everyday language. An insurance agent is going to use some of that language, not on purpose most of the time, but they may use it. When you're shopping, there's a few different ways to shop. There are 3 different ways for a basic type of insurance to buy. Number one is you can just do a Google search. You can go to one of the wide companies where you can comparison shop different insurances, and you can just put in the numbers of what you need, and that will spit out a number. Those websites will generally get a commission for you using their product. The price will most often, if you're going through one of the reputable sites, it'll be the same price you'd pay if you went directly to the company. So there's really no risk there. You're going to overpay, although you might want to check that too. It might only take a few minutes to do that. But you can check online. There's always a cost benefit to all of these things. If you buy your insurance online with a 1-800 number, that's may give you the cheapest cost today, When you have a claim, which is something bad happens, you're also probably going to call a 1-800 number, and you're going to get a random agent, and the claims experience might not be what you want. So realize insurance is like anything else. If you shop at Walmart, you're not going to have a concierge walking you around Walmart, showing you the apples and showing you the soccer supplies, right? But if you go to Nordstrom, you can have a personal shopper. So you're going to get what you pay for. Second thing is, there are people called insurance brokers in every industry. These are professionals. They generally have maybe 10, 15, 20 different companies that they work with, and they will then shop it for you. And they may give you a top 3. They might give you a top 1, but the cool thing is you can ask them for top 3. You can ask them for top 5, and then you can compare. The third, then an insurance broker then will be there if you have a claim. So they are generally your representative. Example company, I believe Mutual of Omaha is a company that a lot of people may have heard of. They use insurance brokers. Citizens uses insurance brokers. You call your broker, they then help you file the claim, and they're there helping you, and they want to keep your business, so they will help you. The third is, some companies have captive agents. These are some of the big companies that you've heard of before. They won't help you comparison shop. They only work for that company. These will be companies like Allstate. Allstate agents don't work with a ton of different companies. State Farm doesn't work with a bunch of different companies. Now, at one time, State Farm was a company where I would tell my clients when I was a financial planner, Rob, you're going to overpay. You will overpay if you use State Farm. And if something happens, it will be taken care of like that, be taken care of very quickly. So you're not going to usually get the top rate. I've heard from a lot of different sources that's changed recently. So I want to ask the question about claims experience. What has claims experience been like? In other words, what's the hassle I'm going to get? I may do a Google search, Allstate claims. And by the way, there's going to be a bunch of disgruntled people that are going to, no matter what company you put in, you're going to find a bunch of disgruntled people. So you're comparing 1-star reviews of all these great restaurants, and you're going, okay, which one seems to stink the least when you're looking at the 1-star reviews? But I would definitely do that. I would also, just as a beginner out there, I would stick with companies I may have heard of, or that people around me have heard of. Ask some people around you if they've heard of that company, if they know that company. It doesn't make them good, but certainly if I've got a company that none of my friends have heard of, none of the people around you have heard of, I would generally stay away from those until you may know better all the different places to look up all the things going on with insurance.
And it's one of those things that you are not married to it for your entire life. Like, this is something that you can re-examine every year, a couple of years, where you're like, okay, let me see if the place I'm with right now is still the best for me. Like, is Geico the best rate for me right now? Or can I go get Allstate to give me a better auto insurance quote for the same product? And you want to try and, like you said, make sure you're getting apples to apples. Like, am I getting the same amount of coverage? Are all the benefits the same? And then how much are you going to charge me as a premium for this service?
I'm glad you brought that up, because something an insurance agent, actually an Allstate insurance agent, really fantastic agent, told me. He said that you want to do that. The time to do that is on your birthday. And the reason for that is because insurance companies have age bands that they will use for their different insurances, where they're marketing specifically to one group of people. So the insurance, you may not change. We talked about the risk, and if you get good grades, or if you're great with your cell phone, whatever it might be, you might have not changed. You may still be the same risk, but you fall out of their age band and they no longer want you anymore. And so this company may raise their rate after you have a birthday, and another company that looked like they weren't great for you before, all of a sudden you're in their wheelhouse. So when you have a birthday is a great time to go compare your insurance coverage.
Okay. And then things that we can do ourselves to keep our insurance premiums low. Things that you think about with health insurance. If you have to get your own health insurance, being a generally healthy person will help with that. So if you can show like that, you don't do things like smoking or drugs, things like that, like you will typically be a lower risk to them than if you do. If you work out regularly, like they will ask you a lot of these questions. And life insurance in particular, like we had somebody come out to the house, take blood samples, did a big survey for us, like on our life habits. I saw when I was doing my research on this that a lot of Americans, I think it was over 29%, are tempted to lie when filling out insurance surveys, particularly about their recreational habits and things that they do like that. What are the consequences to lying when you apply for insurance?
Never lie. Never, never lie. As a guy that worked with a lot of insurance companies on behalf of my clients, I was often an intermediary helping them fill out the paperwork. And then if there were problems, and here's what happens in the contract, which very few people read, there is in most policies a 2-year look back period. Sometimes it's longer. So that if something happens in the first couple of years of you getting the coverage, the insurance company can look at everything about you and accuse you of lying. And if that happens, you may get a return of premium, which is generally what insurance companies do. They'll give you back the money, but they will not keep any of their promises beyond that. Some companies just keep all the money. They're just in their contract. So I would read the contract, but I would never lie to an insurance company. There's another reason for that too, which is that insurance companies share information. So there's a group called the Medical Information Bureau. And if you tell insurance company number one the truth, and then you tell insurance company number two something different, insurance company number two already knows the truth. And it's a little bit frustrating. And actually, we've seen some changes in the industry where companies, especially new companies on the scene, are changing up the game, where they're making these insurance forms less long. They're like, listen, we already have your data. We have it all from Big Brother already. So you only need to fill out these 5 things because we already know so much about you from sources. Is that scary? Yes, it is. But it also is another reason. Just don't lie.
Yeah, I mean, it sounds great on paper right now, but if you are not being truthful when you fill out these things, of course, the insurance company's like, well, look, the numbers we gave you, the risk that we thought we were signing up for is totally different to what was actually going on. So of course, that's a breach of the contract we tried to make. We'll give you back the money that you paid us, maybe, but we're not honoring any of the benefits that we said we would do because you lied at the beginning. So it may be tempting in the short term, but don't do it.
Yeah. Something else there too is that, so I would have clients say, well, hey, Joe, I know that I have this need for insurance. Let's say it's life insurance. I'm a smoker and I've been trying to quit forever. This is the reason why I'm going to try to quit. So I will try to quit. So when I was a young financial planner, I would wait. We get back together 3 months later. How's quitting going? Oh, I can't stop. 3 months later, I can't stop. 3 months later, I can't stop. And it would go on and on and on. Here was a better solution. Get the insurance as a smoker. But before you apply, ask them, if I quit smoking, number one, how much less is my premium? Because that will, behavior is everything. And when you find out just how much more expensive it is to be a smoker than a non-smoker, that'll help you quit. But then the number two thing is you'll find out that most insurance companies are very happy to reevaluate you if you've stopped smoking for maybe a year, 18 months, 2 years, whatever it is. So if you do that thing that you've wanted to do, stop smoking, go ahead and get the insurance you need today so that your family's not at risk. And then 2 years from now, go back and reapply with the new stuff. So whatever the habit is that you're trying to kick, or whatever let's say you have a bad driving record, whatever that is, ask them how soon it will be until you can reapply for the insurance. So pay the high rate now, but set yourself this carrot to get better over the next couple of years.
Yeah. And with auto insurance, look for ways that you can demonstrate that you are a better driver. So can you sign up for defensive driving courses? Can you sign up for the little monitoring device that plugs into a car that I know some of the big insurance companies offer that will basically track you and your driving habits? And if you show that you are a good driver, they're going to be like, okay, you're a lower risk to us. Let's offer you that lower premium because we want your business for life. We want you to stay with us. So they want to keep the people who are going to keep paying the premiums and not, draw on that insurance policy. That's the name of the game here. So do the things that you can to lower your risk to these insurance companies. And then just like you said, keep asking them, what can I do to lower my premium? Go make comparisons. So say maybe get 3 quotes every year or two on your birthday from different companies, just to be like, okay, what else is out there? You may end up staying with the same spot. You may change. You can also bundle your insurance. So if you are getting different types of insurance, you can get them all through one provider, and you might get a discount for doing that. It's like my wife and I get all of our insurance pretty much through USAA. And as a result, they are a little bit cheaper. Okay, Joe, we're at the top of the hour, so I do want to wrap it up and not keep everyone here any longer, particularly you. But what is your number one piece of advice for teens to build wealth in the future? This is a question I ask all of my guests who come on.
Yes. Yeah. And I was ready for this because I know you ask this of everybody. I think the most important thing and the thing that took me too long to realize was to automate the little things. Automation has been the key to more successful people's success than any other thing that I know of. It is that don't trust yourself to save money. Set up something through your bank, through a mutual fund company, through whatever it is to get saving started. Automate that. Have an automated system that helps you track your expenses and sends you alerts when your spending goes outside of bounds where it should be. The more that you automate the little stuff, you can focus on the big stuff. That's fantastic. And then continually have a money conversation, but keep it fun. I like a 20-minute meeting every week with myself or maybe an accountability buddy to talk about how I'm building wealth. What am I doing this week? You know, if I've got a job while I'm in school, am I putting some money away in a mutual fund every week? And what's that look like? And if you keep it fun and you keep it short and you think about your money on a periodic basis, and I say that because a lot of people that I met with would, they talk about their money twice a year. And it becomes this big Camp David summit where it's piles of, research and whatever. And anybody at that meeting who's not a financial geek is poking their eye out and they hate it. So keep it fun, keep it light. And I think you're going to do a better job with your automation.
Okay, so two awesome pieces of advice in there. Automate the little things. So direct transfers from your savings accounts to maybe an investment account or checking to savings, paying bills on time via auto debits are a great way to just make sure everything gets paid on time. Same with your credit cards if you have them. And then the other one was that meeting. And I love that one as well, especially if you have a partner. So you have a life partner that you are with, meeting with them every once in a while to make sure you're on track with your finances. For all of you in school, like you're in a classroom potentially full of other young people the same age as you who are thinking about going on this financial independence journey. Check in with them every once in a while. Like, hey, how's your financial independence journey going? What are you doing? Are you sticking with your goals? I do that for working out right now. I have a friend who's actually across the Atlantic Ocean, and we check in with each other once a week to be like, you stick with your health goals this week? And, you don't want to be the person that turns up and like, no, didn't do it. So That's it cool. Helps keep you on track and keeps you moving forward. Joe, thank you so much for your time today. Where can, if people want to find out more about you, if they want to listen to Stacking Benjamins, they want to get in touch, where can they find you?
Thanks. Stacking Benjamins every Monday, Wednesday, Friday. We call it the greatest money show on earth because as Rob, it is truly a circus on purpose. It's meant to be your catch up 3 times a week and just keeping it top of mind. We have a lot of fun. There's a lot of humor and we try to keep it light on purpose. It's live from my mom's basement. And then of course, my book, Stacked, it just takes you through not just insurance, but all the different pieces of financial planning. It's meant to be like the Cub Scout Wolf Guide meets the Hardy Boys Detective Manual. So each chapter is an achievement. So you take the achievement you're trying to get and you just read that chapter and do the stuff. And hopefully then you get stacked. So those are the first 2 places. You can say hi to me anywhere on social media. Instagram is a good spot. Stacking Benjamins podcast. Just say hi.
All right, Joe, thank you so much for being here today. Thank you, everyone who's watched this live. If you're joining us for the replay, thank you for spending your time with us. Don't forget to hit subscribe so you can see when any future guests are coming along, and we hope to see you next time. Thank you, Joe.
See you later, everybody. Bye.